As someone past 60 who maintains a checking account, there are three enforcement realities the IRS and the banking system apply to you at this very moment, and not a single one of them arrived as written correspondence in your mailbox. There was no official announcement, no informational card, just revised compliance guidance sitting quietly inside examiner manuals that the majority of seniors will never lay eyes on. I'm covering all three of them today. The figure you were trained to monitor that no longer tells the complete story, the routine cash behavior that can get your account flagged, and the family money transfer that can become a tax complication if you aren't careful. Stay with me because the third one represents the exposure that the greatest number of seniors already carry without any awareness of it whatsoever. I'm Lona Hart. Each week I break down financial and legal subjects in everyday language so you can safeguard what you've worked to build and make your retirement years less stressful to navigate. If that sounds worthwhile to you, go ahead and hit subscribe so you don't miss what's coming next. Rule 1. The $10,000 figure isn't telling you everything. Most people over 60 were taught one particular number a long time ago, $10,000. Stay below it and everything is fine. That was never entirely accurate, and it carries even less truth today than it ever did before. Under the Bank Secrecy Act, any cash transaction, whether a deposit, a withdrawal, or an exchange totaling more than $10,000 within a single business day, requires your financial institution to submit a currency transaction report to FinCEN, the Treasury Department's Financial Crimes Enforcement Network. This obligation exists because the regulations implementing the Bank Secrecy Act require financial institutions to file reports of cash transactions exceeding $10,000 in daily aggregate. That report includes your full name, your address, your social security number, and the complete details of the transaction, submitted electronically within 15 calendar days. You will not receive a copy of it, and the person behind the counter is not going to walk you through what just happened. It all occurs in the background, precisely as it has since Congress established the $10,000 threshold back in 1970 and reinforced it through subsequent legislative amendments. What has shifted is what compliance software actively monitors around that number. Banks now operate pattern detection systems that flag accounts displaying repeated deposits or withdrawals clustered just beneath $10,000, particularly on accounts that regularly receive benefit payments, retirement distributions, or recurring transfers from family members. The threshold itself has remained unchanged, but the behavior surrounding it draws considerably more automated scrutiny than it ever did previously. There is a second type of report that most seniors have never once encountered, and it doesn't wait around for any large round number to appear. It's referred to as a Suspicious Activity Report, or SAR, in the case of a bank or credit union. The regulatory minimum for a mandatory SAR filing is set at transactions totaling $5,000 or more connected to activity the institution considers suspicious, although banks retain the authority to file one voluntarily on smaller dollar amounts whenever their internal systems identify something out of the ordinary. Either way, the report is produced by software that monitors behavioral patterns rather than simply the size of a single transaction, and you are never informed when one has been submitted on your account. Federal law makes it a criminal offense for any bank employee to alert a customer that a SAR has been filed, with penalties reaching up to 5 years of imprisonment. One additional detail worth carrying with you: money orders, cashier's checks, and traveler's checks purchased using cash in amounts ranging from $3,000 to $10,000 require the institution to verify your identity and maintain a record, even though no CTR is triggered at that particular dollar level. It represents a lighter version of the very same paper trail. And this applies across the board, credit unions included. If you moved your savings to a local credit union under the impression that it operates outside these requirements, it does not. Every federally insured institution operates within the identical Bank Secrecy Act framework. There is no exemption granted based on the size of the financial institution. The genuine protection doesn't come from switching where you bank. It comes from understanding what actually causes a report to be generated in the first place. Rule 2, the ordinary habit that can appear to be evasion. That leads us directly to Rule 2, the one that transforms a completely innocent, everyday routine into a federal flag on your account. Consider Diane, 67, a retired county clerk from Albuquerque. For 11 consecutive years, she withdrew $800 in cash every 2 weeks to cover her household running costs. After her husband passed away, she increased that figure to $1,000 to absorb the bills he had previously managed on his own. 6 weeks later, her bank's monitoring software flagged the account and a SAR was submitted. Diane had not done a single thing wrong. She was a widow making a reasonable budget adjustment, but the automated software interpreted her newly consistent pattern as a possible effort to structure transactions deliberately. She didn't learn that any report had been filed until months afterward during a standard account review, when a compliance officer asked her to explain the change in her withdrawal behavior. She was able to resolve the matter because she had retained receipts showing that her increased withdrawals corresponded directly to bills she had taken over managing. But right up until that conversation occurred, she had absolutely no idea that anything had ever been filed on her account. This situation falls under a legal concept called structuring, defined within Title 31, Section 5324 of the United States Code. Critically, it does not require any proof of actual intent to break the law. A behavioral pattern that merely resembles an attempt to remain beneath the reporting threshold is sufficient to invite scrutiny, regardless of the original source of the funds or how completely legitimate they happen to be. If you handle cash on a regular basis, the solution is straightforward documentation, a single brief note each time you make a transaction, the date, the amount, and the reason behind it. If you're moving a larger sum between accounts you own, complete it as one consolidated transfer rather than spreading several smaller ones across multiple days. And before you reach the action steps toward the end of this video, pull up your last 90 days of account activity. If you notice 3 or more deposits or withdrawals falling somewhere between roughly $5,000 and $9,500, write that observation down. You'll want to reference it shortly. Rule 3, money that never felt like income to begin with. Now we arrive at the rule involving money that doesn't feel like income in any meaningful sense. Your daughter sends you $400 for groceries. Your son transfers you $600 through a payment app to help cover an unexpected car repair. None of it registers as taxable income in your mind. And in this particular area, the rules have actually moved in your favor more meaningfully than most people have come to appreciate, though genuine confusion surrounding them remains widespread. For a period of time, Congress and the IRS were actively moving toward drastically reducing the reporting threshold for payment platforms like Venmo, PayPal, and Cash App, initially down to $2,500 for the 2025 tax year, with plans to reduce it further all the way to $600 beginning in 2026. That direction generated considerable anxiety among retirees who regularly receive financial assistance from their children. But that lower threshold was reversed under the One Big Beautiful Bill Act, signed into law during July of 2025. The reporting threshold for Form 1099-K returned to the level that existed before 2021. Third-party settlement organizations are not required to issue that form unless a payee's gross reportable payments exceed $20,000 and the total number of transactions surpasses 200 within a single calendar year. So for both the 2025 and 2026 tax years, informal family transfers of a few $100s here and there are extremely unlikely to generate a 1099-K from the application itself. That said, 3 important considerations still deserve your attention. First, a number of states have established their own significantly lower reporting thresholds, with some set as low as $600. Depending on which state you reside in, a form could still arrive even when the federal threshold hasn't been reached. Second, Zelle operates differently from Venmo, PayPal, or Cash App because it processes payments as direct bank-to-bank transfers rather than routing them through a third-party settlement network. As a result, it falls outside 1099-K reporting requirements entirely, regardless of the total dollar amount involved. Third, and this is the element that remains entirely unchanged, if the money you receive genuinely constitutes business income rather than a personal gift, it is taxable whether or not any form was ever produced. The absence of a 1099-K does not eliminate that tax obligation in any way. Here is where people continue to get caught. If a platform does surpass the threshold and issues a 1099-K and you fail to account for it properly on your return, the IRS's automated matching system identifies the discrepancy. The correspondence that follows is called a CP-2000, not a formal audit, but a proposed adjustment to your tax liability with interest added on top. Consider Patricia, 71, a retired home health aide living in Memphis. She received a CP 2000 notice in March asserting that she owed $1,840. She had not worked at all during the year in question. Her 3 adult children had collectively sent her approximately $3,200 through Venmo to help with prescription costs, household bills, and a replacement refrigerator, some of it routed through a business-flagged account and some subject to her state's lower reporting threshold. The IRS matched that form against her submitted return, identified a discrepancy, and gave her 60 days to respond before the proposed adjustment became automatic and binding. The remedy is straightforward. Ask family members to include the words "personal gift" in the memo field whenever they send you money through a payment app, and maintain a simple ongoing record of what came in and the reason it was sent. Gifts are not considered taxable income to the person on the receiving end, but you need to be capable of demonstrating that fact clearly if a form is ever generated and questions follow. One final point worth keeping in mind: the IRS generally has 3 years from the date a return was filed to raise questions about it. That window stretches to 6 years when unreported income amounts to more than 25% of what was originally declared. That means a discrepancy from 2 or 3 years back can still surface today, even if no notice ever reached you at the time it originated. If you've been receiving regular financial assistance through payment apps for several years without tracking any of it, it is worth pulling your app transaction history for the past few years now, not exclusively the current year. Now, before you close this out, here is your action plan presented in sequence. Step 1, request your free ChexSystems report and review it carefully for any flags or account closures you weren't previously aware of. Step 2, for the next 90 days, log every recurring deposit, noting the source, the amount, and the date it arrived. If family members send money through any app, ask them to include a brief note confirming it is a gift. Step 3, consolidate any planned transfers between your own accounts into a single transaction rather than multiple smaller ones, and include a short memo describing the reason for the movement. Step 4, total up every payment received through Venmo, Zelle, PayPal, and Cash App over the past 12 months. If any single platform has crossed $20,000 combined with 200 or more transactions, or has exceeded your particular state's lower reporting threshold, and that activity isn't reflected on your return, gather your supporting documentation now before any CP 2000 notice has the opportunity to arrive. Step 5. If a CP 2000 does land in your mailbox, respond in writing before the deadline printed directly on the notice, which is typically 60 days from the date the notice was issued, not the date you happen to open the envelope. Include a concise explanation along with your supporting documentation and a signed personal statement. If the amount being proposed exceeds $5,000, bring a licensed tax professional into the situation before you submit your response. Step 6. Consider placing a free security freeze on your ChexSystems file if you have no plans to open any new accounts in the near term. It will have no effect on your existing accounts, but it does limit the way your transaction history gets shared with external screening tools going forward. Not one of these 3 realities arrived with any advance warning attached to it. Your bank is legally prohibited from informing you that a SAR was filed on your account. A payment application will not alert you when it reports a family transfer to any authority. That built-in silence is an intentional feature of how this entire system was designed to function. Understanding the actual rules and keeping consistent documentation as you move through your financial life is precisely what prevents a quiet background flag from ever developing into something genuinely serious.